the best stocks to buy during a stock market crash. Today, the S&P 500 is down 3% and year-to-date the S&P 500 is down 21%, which is a lot. And a lot of people are saying a stock market crash is coming very soon. To me, it doesn't really matter because I've been waiting a long time to see my favorite stocks to come down. And all this time I've been increasing my cash position, so I'm ready to buy. But with all these stocks coming down and a potential stock market crash around the corner, I think it's the best to check which stocks are the most interesting to buy right now or during the stock market crash. So in this video I'm going to present my favorite stocks which I'm going to buy very soon if they continue to go down. I'm very excited to see what you guys think about these stocks, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analysis every week, where I will tell you everything you need to know about the stock market. So, first stock on this list is Google, and it has to be mentioned that I don't own this stock right now. So Alphabet, the parent company of Google, is down almost 26% year to date and is going for a stock split of 20. So basically they are going to cut the share into 20 smaller shares. This doesn't change anything about the fundamentals or valuation directly. So instead of $2,100 or maybe $2,200 a share, you will pay $110 after the stock split, if the price stays at this level. But to be honest, I think the stock price will go down between now and the stock split date. So you are going to pay less than $110, I think. And to me, this is a no-brainer. Google has a PE ratio around 20, and for a company this big, they are growing very fast. The revenue 5-year compound annual growth rate is sitting at 23%, and the net income compound annual growth rate is sitting at 38%, meaning margins are increasing. The leverage free cash flow is also growing very nice with 30%. In the past couple of years, Google started to buy back shares, which is a great thing. That adds a lot of value to the investor. And they have plans to repurchase up to 70 billion of its own shares. Another thing that I like about Google is the high amount of return on assets, return on equity and return on invested capital. All these numbers look very good to me. The last thing that I want to highlight is the total amount of cash they have right now. Almost 134 billion, and with debt sitting at only 28 billion, they are capable of paying down all the debt very easily. So personally, I can't wait for the stock split, and I will definitely buy this stock when valuations stays the same. Next stock on this list is Nike. Again, I don't own this stock right now, but it's on my radar. And when it continues to fall down, this stock can become a buy for me. Right now, Nike is down almost 33% year to date, but PE ratio is still sitting at 28, which means you pay a premium for Nike stock. And with the current situation, I think the best thing to do is to wait for the stock to come down even more. The fundamentals of Nike is something I really like. Return on assets, return on equity and return on invested capital all look good to me. And one of the things I like about Nike are the increasing margins. The 5-year compound annual growth rate for the revenue is sitting at 6.6%, while the net income compound annual growth rate is sitting at 13.5%. So as I said, margins are increasing. One of the reasons is the focus on direct-to-consumer sales and cutting the middleman. Right now, Nike has 13.5 billion in cash and 12.6 billion in debt, so they can pay off all the debt very easily, which is a great thing. Another great thing is that Nike has bought back roughly 4.5% of the total shares outstanding in the past 5 years. But keep an eye on the future, because recently they have issued new shares and that's something you don't want. The last thing I want to mention are the dividends. Nike has a 1% dividend yield. Payout ratio is sitting at 30%, the 5-year growth rate is sitting at 11%, which is very good, and they grew the dividends for 20 years in a row. Also very impressive. So, final conclusion is that I'm going to wait a bit longer to see the stock price to come down even more. I'm not going to perfectly time this stock of course, but I think it will go down a bit more in the coming days and weeks. Next stock on this list is Starbucks. I do own this stock and right now it's down 37% year to date, so that's a lot. PE ratio is sitting at 19, which could indicate that it's undervalued. I really like the return on total capital and return on assets, but a thing that I don't like is that they put a stop on the share buyback program. This was one of the things I really liked about Starbucks. They bought back roughly 20% of the total shares outstanding in the past 5 years, which is really a lot. But a thing that I and a lot of other investors still love are the dividends. Dividend yield is sitting at 2.6% and payout ratio is sitting at 57%. The 5-year growth rate is sitting at 15%. And they grew the dividends for 12 years in a row. Very impressive. So my final conclusion with this stock is that I think it's undervalued based on the PE ratio. But there are some things that I don't like about this company. And one of them is the share buyback program for the coming periods. I will do a full new analysis on this company very soon. But at current prices, I think Starbucks could be an interesting stock, especially if they are continuing to go down in stock price. The next stock on this list is Abbvie. I haven't been talking a long period about this stock, but at current prices I think it's a very interesting stock to analyze. I do own the stock for a long period of time, and one of the reasons are the dividends of course, but more on that in a minute. The stock is up 4% year to date, but since the all-time high this year they are down almost 20%, which is a lot. There are a few negative things about this company. First is that they issued 10% new shares in the past 5 years. The second thing is that they have too much debt compared to the free cash flow, so this is something to dive into. The PE ratio is sitting at 21, which is fine by me because you don't want to pay a premium. But it's for most investors all about the dividend with this stock. Right now, dividend yield is sitting at almost 4% and payout ratio is sitting at 42%. And the 5-year growth rate is sitting at 70.5%. They grew the dividends for 9 years in a row. So, from a dividend perspective, this stock is a very interesting one at current prices. But again, it feels that this stock will go down even more. So for now, I think the best thing to do is wait just a little bit longer. Next on this list is Microsoft. And I want to highlight just a few things with this one. It has to be mentioned that Microsoft is my largest position. Right now, Microsoft is down almost 27% year to date and has a PE ratio of 26. Microsoft is one of the largest companies in the world and they still have a 5-year compound annual growth rate of 16% in revenue. Net income is at 27%, meaning margins are increasing. Free cash flow is growing at 23%, which is also very high for a company this big. Return on assets, return on equity and return on invested capital are at high numbers, which is a good thing. Especially the return on invested capital is something I really like about Microsoft. Microsoft also bought back a decent amount of shares in the past couple of years, and that's because they have plenty of cash available. Right now, cash is sitting at 104 billion and debt is sitting at almost 78 billion. So they have plenty of cash to pay down all the debt, which is insane. The last thing I want to show are the dividends. Right now, dividend yield is sitting at 1% and the payout ratio is sitting at 26%. 5-year growth rate almost at 10% and they grew the dividends for 18 years in a row, which is really nice. For me, this stock is a buy because I really like all the fundamentals of Microsoft. They have plenty of cash and they are still growing in high amounts. But for now, I think I will wait just a little bit longer to come down a little bit more. The last stock on this list is my favorite one, Visa. I do own this stock and I think it's worth a premium stock price. This stock is down 12% year to date and has an interesting going up and down pattern. PE ratio is sitting at 31 right now, which means you pay a premium for the stock. Visa is still growing at almost 10% on the 5-year compound annual growth rate, which is a lot for a company this big. And a thing that I really like about Visa is the fact that the net income margin is sitting at 51%, which is insanely high. Return on equity is sitting at almost 37%, return on assets at 14% and return on total capital at almost 20%. Another thing I really like about Visa is that they bought back almost 30% of the total shares outstanding in the past 5 years, which is a really high number. And the reason why they can do this is because they have a lot of cash available. Visa has 30.5 billion in cash and debt is sitting at 21 billion. So they are capable of paying down a big chunk of the total debt, which is always a good thing. The last thing I want to show are the dividends. Right now, dividend yield is sitting at 0.75%, but it's all about the growth with this one. Payout ratio is sitting at 21% and the 5-year growth rate is sitting at almost 18%. They grew the dividends for 13 years in a row. Final conclusion, with the stock price coming down, I think it could be very interesting to increase my position with this stock. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the companies to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.